In this week's video, we'll review the latest charts, data sets, and scores to help us answer the question, is it time to load up on small caps? We'll be moving quickly, so feel free to use the pause button on your video player. Regardless of what stocks or equity ETFs you own, all things being equal, it's good news for the stock market if small caps can break out of this long-term consolidation box. This is calendar year 2022 here, 2023 here, and into 2024 here. Back in mid-May 2023, we noted numerous tight cluster looks. Those turned out to be helpful. From a technical and psychology perspective, you can think of this as a coiled spring. This is a weekly chart. It's as of the close on Thursday, February 29th. The longer we can remain above the blue box, the more relevant it becomes. It's also a good sign to see the S&P 500 financial sector exceeding this weekly high here from 2022. And the same can be said for the industrial sector. Breakout above this level here, a retest look here in 2023. This is October of 2023 here. And now what looks like a successful retest. Secular trends have a tendency to make a stand at or near an upward sloping 200-week moving average shown in red. And it finally looks like the equal weight S&P 500, which has been a long-term laggard RSP in the ETF world, is breaking out above that weekly high from 2022. That is also good news. However, from an asset allocation perspective, this improving look on small caps is occurring within the context of a long-term downtrend relative to other options. This is small caps IWM, upper left-hand corner, divided by ITOT, the U.S. total stock market ETF. The moving averages on your screen range between the 20-day in blue and the 250-day in black. If this daily trend is going to reverse in the favor of small caps, which absolutely positively may happen, the trend has some work to do. Blue, the fastest moving average, is on the bottom. Black, the slowest moving average, is on the top. Until proven otherwise, even if small caps outperform, as they did here, any outperformance would be seen in the short to intermediate term as a counter-trend move within the context of a long-term downtrend. And obviously that's subject to change. This is a daily chart going back to 2021. If we look at a weekly chart going back to 2012, pretty clear to see that this is a counter-trend move that fails. This is a counter-trend move that fails. This is a strong counter-trend move that fails. A counter-trend move that fails. So while it's possible we may allocate some resources to small caps, we would be taking a very small position based on this well-established and existing downtrend relative to other options. As we noted 2 or 3 weeks ago, this would be a good first step to maybe get our attention. Hasn't happened yet as of the end of February. Small caps IWM daily relative to SPY, similar situation. Blue, the fastest moving average, is on the bottom against IWM. In black, the slowest moving average is on the top, also trending against IWM. We're not rooting for or against small caps. We're simply stating a fact. The relative downtrend is still in place as shown in this daily chart going back to 2021. And it's even more clear on this relative chart IWM divided by SPY weekly going back to 2012. Even in this instance, blue, the fastest moving average, is on the bottom. Pink, the slowest moving average, is on the top. This is the 200-week here. This is the 30-week down here. Again, this would be a good pay closer attention type look. Something that may happen very, very soon. It hasn't happened yet. And as we've noted in recent weeks, the anchored volume weighted average price lines are also telling us IWM has a lot of work to do before it establishes a primary uptrend relative to the S&P 500. Same can be said for the equal weight S&P 500 RSP relative to SPY. This is 2017 here. This is 2024 here. Notice the slopes of the anchored volume weighted average price lines. They are all down. So while this is unequivocally good news, based on our time horizon, which is several years down the road based on the secular trend, on a relative basis, RSP has not shown a lot. Very similar situation with midcaps relative to the S&P 500. This is MDY relative to VU in the ETF world. Blue, the fastest moving average, the 20-day is on the bottom. Black, the slowest, the 250-day is sloping downward, and it's on the top. Is it possible this setup here is similar to this setup here? Absolutely, positively, yes, it's possible. We take it day by day, and we don't close any doors on any options, including small caps and including mid caps. This is the daily going back to 2021. Mid caps clearly in a long-term downtrend when we look at the weekly chart relative to SPY going back to 2012. There are some subtle hints on this chart telling us to keep an open mind about the possibility of a trend reversal. Again, this would be a good first step. So if you're wondering, why am I hearing so much about mid caps and small caps? Well, they do have very attractive setups in isolation. This is MDY in isolation. This is a weekly chart. It's trying to break above a long-term consolidation box. However, notice MDY here is trending up. On a relative basis, during the exact same period, MDY is trending down relative to SPY. These are two different questions. Is this an attractive looking setup? It is. Is MDY the best place for our capital? At the moment, there's not a lot of evidence to support that. We'll see how it evolves. Moral of the story. This is good news for the stock market. It's good for SPY, it's good for XLK, it's good for growth stocks. The same can be said here, and the same can be said here. All of it is evidence of a rally that's broadening out. You can see prices exceeded this high. The moving averages are turning up. Price made a stand at an upward sloping 200-week here. This is one side of the coin. From a long-term asset allocation perspective, this is the other side of that same coin. RSP relative to XLK, the tech sector ETF, going back to 2014, still on the weekly chart has a full-bore bearish look. XLK is not going to outperform forever. At some point, even if this downtrend remains in place, there's going to be a counter trend move, a period where RSP outperforms XLK. If the ratio chart on the bottom portion of your screen starts to morph into something more like this chart here, RSP in isolation, then we may have a leadership change. We don't have that yet. The same concepts apply to small caps. Lower right-hand portion of your screen is small caps relative to semiconductors weekly. This is a good look for XLI in isolation, but as shown on the lower right-hand portion of your screen, it's not made a lot of relative progress relative to XLK. It's not a commentary on what's going to happen next. We'll see how it unfolds. And while this is a constructive look up here for XLF in isolation, the relative chart has a significantly different look. XLF relative to XLK, lower right-hand portion of your screen, weekly going back to 2014, 200-week moving average shown in red. We just compared these ETFs to XLK, the tech sector ETF. How about if we compare them head-to-head with the S&P 500 ETF SPY? IWM relative to SPY, still in a downtrend. RSP relative to SPY, still in a downtrend. XLF relative to SPY, showing some signs of improvement, but the ratio is still trading below the 200-week moving average. In midcaps MDY, it looks better than IWM and RSP on the relative chart, but it still has some work to do. Let's shift gears. Take a look at the Nasdaq composite weekly. If you compare the right side of the chart over here to this period here and this period here, this is a constructive look. This is a constructive look. We've covered this chart numerous times over the past year. Same can be said for this chart, which still has a constructive look from a long-term perspective. And if we look at the Nasdaq from a shorter-term perspective, this is the 8-day moving average relative to the 50-day moving average. Blue, the fastest moving average, is on top. Gold, the slowest moving average, is on the bottom. We don't have anything yet here on February 29th that even tells us some type of pullback is a high probability outcome. It's probably fair to say this looks a lot more like this constructive period here relative to this pullback period here. 8-day rolling over here, 8-day turning up here. Weekly cloud checking all the bullish boxes. And the Nasdaq relative to the S&P 500 on the anchored volume weighted average price chart is currently above several key areas. The longer above, the more relevant it becomes. This tells us here that the prior uptrend is trying to reassert itself after this counter trend move. Same can be said for this chart. Nasdaq weekly relative to the S&P 500. If you hear talk of a parabolic advance or a stock market bubble, this looks nothing like a parabolic advance or a stock market bubble. Doesn't mean the stock market's going to go up next week, but we're not dealing with a parabolic advance here. It's the Dow Jones composite average here. This is calendar year 2021. This is a year later in 2022. This is 2 years later in 2023. We're approaching 3 years later in 2024. The longer a market goes sideways, the bigger the move that you can expect to get when you either get a bullish breakout or bearish breakdown. Right now, we are trying to complete a bullish breakout. Very, very similar concepts from our Twitter feed at Shavaco Capital relative to this info here. Clients and regular viewers may remember way back in Q4 of 2022, we performed a study based on this chart. Historically, it said to keep an open mind about better than expected outcomes. The chart at that time at 10:8 here, chart on your screen is dated October 31st, 2022, is a chart that we covered in a video in 2022. This chart, which was at 10:8, is now over 12:4 on February 29th. Much improved look on the weekly cloud and well above this weekly high here on February 29th. Doesn't mean the Dow Jones composite is ready to lead. It's still clearly in a relative downtrend, a long-term relative downtrend relative to the Nasdaq. Similar broadening outlook here, Dow Jones Industrial Average. This is priced back here in a similar area in 2021, early 2022. It's a very constructive turning up look on the weekly chart. Constructive weekly momentum making a stand near the zero line in 2023. Checking all of the bullish boxes on the weekly cloud. Not the case if we look at the same Dow Jones Industrial Average relative to the Nasdaq. The weekly cloud chart is checking all of the bearish boxes, meaning it's still in a relative downtrend. This tells us that our laggards are starting to break out. That's a good sign. Nasdaq 100 in isolation, checking all the bullish boxes. Covered this chart numerous times in the past. You can pause your video player. This is a very constructive look here relative to long-term outcomes, talking several years potentially down the road. We noted in 2023 that this tight look was constructive. Good things have been happening. Can make an argument this look in here is similar to this look here in 2010. When things weren't going particularly well in September of last year, we showed this chart and said it really didn't look that bad. This is the NYSE composite. This is the 50-day moving average here in blue. This is the same chart as of February 29th. Also above this high here from 2022. And a very constructive turning up look on the 200-day moving average. If you pause your video player here, the concepts, upper left-hand corner of your screen, very similar to these concepts here. This is after the dot-com bust bear market. This is after the financial crisis bear market. This is 2024. Compare and contrast the look of the weekly cloud here in 2022 relative to the look on February 29th using these bullet points and these bullet points. Could spend a lot of time on this chart. You can pause your video player. It's constructive. Blue above red above the cloud. Blue above red above the cloud after a drawdown in 2011. Stock market rallied into 2015 after this cross. The stock market rallied after this cross, blue above red, into the year 2000. The stock market rallied from this cross here in 1991 into this peak here in 1994. Doesn't predict anything, but it's probably fair to say it doesn't look anything like blue dropping below red here in 2001 or blue dropping below red here in 2008. Remember, we're not just looking at a bunch of lines on a graph. We're using these charts to keep tabs on human behavior and to keep tabs on the acceptance of risk and the aversion to risk. This is what risk aversion looks like. This is what the end of February looks like. Physical gold relative to the S&P 500. We showed this chart in December of last year. It told us to keep an open mind about better than expected outcomes in the stock market. If we look at the same chart at the end of February, the 200-week moving average here in red looks like it's starting to roll over. Nothing particularly convincing here, but it still sides with stocks on a relative basis over physical gold. This is the S&P 500 here for comparison purposes. Covered this a few weeks ago. It's still a constructive and risk-on look. Covered this chart to help us keep an open mind about better than expected outcomes in November of 2023. Again, in mid-December of 2023. And it's still sending the same message at the end of February in 2024. This really doesn't look anything like this. This was the keep an open mind about better than expected outcomes look that we covered in the December 1st video. The chart is dated November 30th. Very similar message and constructive message on February 29th, 2024. In a recent video, we talked about mid-May 2023 as being a turning point. We started to write these articles here. I believe one of those articles mentions this tight converging look here in mid-May 2023. If we look at the same chart, February 2024, it's still constructive and holding this breakout here. Covered this one numerous times. November, mid-December, told us to keep an open mind about better than expected outcomes. This, the end of February, really doesn't look anything like this in late 2007, early 2008. This chart was helpful in mid-May 2023. It's still constructive in 2024. And continues to align with the constructive concepts covered in May, June, and July of 2023. When we talk about this concept and show charts like this and this, it speaks to broader participation, which is basically market breadth. There's another way to look at market breadth. Nasdaq, new highs, new lows. You can make an argument this is the most sustained improvement that we've seen. Still has work to do. So the chart that we covered back in November said we wanted to see this improve. It has improved over here on the right side of your screen. Compare it to this period here and this period here after major lows in the stock market. Spent a lot of time on this chart. Drop below the center line. In this case, tag the lower end of the Bollinger Band. Now we've made it back to the upper Bollinger Band. Present day has some similarities to 2010, 2013, and 2016, all constructive periods. Long-term period of consolidation, we're above that box. A lot of damage in here, trying to move away from this base. If you know your stock market history, 2020, 2019, 2016, 2011, 2009, walking forward, those are constructive setups. Covered this countless times. This is a very constructive look from a long-term perspective. Same can be said for this chart. In this chart, all three of them speak to long-term momentum. These are barge turns. And all three of them align with constructive longer-term trends. And all three of them align with all of the information that was covered back in 2019 and again in 2023, and the secular concepts covered in June of 2023. Everything in this video and all of the demographic concepts align extremely well with the facts presented in these three charts. The CCM secular volatility model helps us monitor our base case, which says we're in a secular bull market that's primarily driven by favorable and improving demographics. And the unbiased and database scores shown on your screen, and the fact that our laggards are starting to break out in a constructive manner, in this long-term Nasdaq 100 setup, all of it tells us to keep an open mind about much better than expected outcomes, looking out several years, while maintaining realistic expectations about how markets operate in the real world. Even if really good things are going to happen in the next 5 to 12 years, drawdowns, even double-digit drawdowns, painful drawdowns, from a historical perspective, they're most likely inevitable. So we'll continue to work on the secular volatility model to help us prepare for future storms that we know are coming at some point. Continue to make progress on the very tedious research that can help us reduce the probability of ever experiencing a drawdown like this or this. And one of the reasons why we opened up with relative trends, in the context of a secular bull market, we should be thinking about what our positions might be worth several years down the road, which means in this environment we want to stay invested in long-term market leaders. Some interesting looks here that tell us something about demographics and the strength of the economy. Covered this chart in late August, early September, said it was constructive. Chart on your screen is dated August 30th. It remains constructive at the end of February 2024. And we've talked about the fact that the boomers may not be as big a drag as previous older generations. Why? They have a lot of 401k money. They have a lot of wealth. They're traveling and they're eating out. The breakout above the 2021 high as the 200-week moving average in red turns up. Markets are said to climb a wall of worry from a psychological perspective, and they're said to decline on a slope of hope. There was a lot to be concerned about at the end of January and early February 2024, and despite that, heading into the last trading day of the month, the S&P 500 was up 224 points. The chart on the left side of your screen is March 1st, Friday at 12:20 p.m. Eastern Time, and the market's up 34 points for the week. Moral of the story, there's a reason why we say we want to take things day by day. Trying to anticipate or being overly concerned about corrections and or drawdowns can significantly harm performance. Thus, in recent weeks, when we're saying drawdowns are inevitable, that doesn't mean we think a drawdown is imminent. In fact, the numbers that we've been showing during the entire month of February say that the probability of a drawdown occurring, a significant drawdown occurring relatively soon, those odds are low. They're quite low. That's obviously subject to change, but the point of all of it is it hasn't changed in the month of February, and we'll continue to take it day by day. The bullet points from last week's video still apply, and we all know, under our approach, if we're going to use all of this effectively, and we're going to avoid this common pitfall, it's extremely important that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.